If you look back at the bull markets in gold over the last 40, 50 years, they've all been about eightfold moves. Okay, where was the last bear market low? 1,050 area. Okay, so when you say gold could go to 8,000, you're not saying anything more extravagant than what happened in the prior three bull markets in gold the last 40, 50 years. Went up eightfold. Now, we're in different times now, so I admit that even that 8,000 may just be a routine, another typical gold bull market. And it wouldn't surprise me it goes way beyond it. Okay. Gold is not on its own here. We've got a crisis of major proportions that's been building in asset categories over the past decade plus that has created price distortions, false investments, false notions. And when they come unwound, when the error is exposed, sometimes the reversion to correct the error is even more dramatic than the error itself. Okay. And it wouldn't shock me that certain things go down more than they probably are justified to do, and some things will go up more than justified. Markets often overshoot, right? Yep. Well, let's talk about the silver question, $200. Well, silver is definitely very much restrained to gold. Right now, it's outperforming again. In other words, over the last year or so, it's been an outperformer to gold. So it's been better to own silver the last year and a half than it has been to own gold. And it's likely to continue that way for the next couple of years. But why $200 on silver? Well, it's more or less a logarithmic scale measure where we look at the prior peaks. There were two peaks, 1980 and in 2011, they were either side of $50. Yeah. And in between, we were down to as low as, recently as $11. And after the first time to 50, we went down to, I think, about $5. But when we look at a logarithmic scale of silver, it looks like not only should it, one, go up to challenge the two prior highs, but take them out and probably go as much on a log scale beyond that as they've been living below that dual peak. And that would put silver more in line with gold. In other words, it would catch silver up to what gold has done. Gold hasn't hit multiple highs in a flat level. It's made higher highs each time. Silver hasn't. And I think silver's about to unleash in a way that not only takes out the dual highs, gives you a triple top breakout above 50, but catches up to gold on a long-term basis. And as long as we see, one, gold in an uptrend, which is not being threatened whatsoever by this protracted pullback, and two, silver on a spread basis continue to outperform gold, which it's doing, we'll continue to hold with the idea that, one, gold's probably going to 8,000 minimum, and silver's going to catch up to it historically. And I think there's some other folks that have come up with numbers like that, even higher than 200. And I could be understating the case. And also when they collapse, they go way beyond their reality. Yeah. So we collapsed from 1570 in 2007 high down to 667 in March of 2009. We probably overshot the downside. Maybe reasonable for it to gone from 1,500 down to 800 or something. We were down to 600s. Okay, so markets tend to, as they get into a trend and mature in that trend, the emotion tends to build. Late comers in the market join. The people who didn't buy at the opportune time suddenly say, God, I got to have some of that. Like the Bitcoin buyers right now, for example. And we've seen this at gold peaks too, where, the guys who didn't own gold at the right price suddenly join in late, and they pay for that. And so it's not just a fundamental reason that certain markets are mispriced historically due to changes in the money unit, for example, but also in relation to each other. Gold, for example, during the 2000 to 2011 period, everybody looks back and says, gee, boy, stock market went up a lot then, U.S. stock market. You compare it to gold, no, it didn't. Gold beat the pants off the U.S. stock market, even though the stock market was soaring. Gold beat it on a relative basis. That all changed between 2011 and 16. Gold gave it back, stocks kept going up. So there's an inhale and an exhale, and quite often it gets excessive on either end. And that would not be surprising this time. Silver, in contrast, only broke out of its price base and annual momentum base, by the way, When it came up through $19.48, that was our trigger number in July of last year. At that point, we said silver is likely to go up to about $30 in the first surge. That's exactly where it went. Since then, it's gone into a very tight range. Actually, if you look at weekly closes of silver, it's been from below 28 on the upside, and generally the extreme low is about 22. So it's been in a $5 or $6 range, and right now we're in the upper half of that range.
Yeah.
And this is freshly after silver broke out of a 7-year wide base. Why should it make a surge and then top? Give it some time. It's a massive price base. In fact, it's one of the biggest bases silver's ever created. Also, it's true with gold. So expect some sustainability time-wise here. And also, I think before gold ever ends, you're going to see something we haven't seen yet out of gold. We've seen it out of silver, where this post-breakout surge was 50% gain in 3 weeks.
Yeah.
Went from the 19s to 29, okay? 3 weeks of July and August of 2020. Gold's advance has not been explosive. It's been layered. It's not been irrational. It's not been emotional. Whereas it did a couple $100 moves and then would pull back, and then a couple $100 move and then pull back over spans of time. You're going to see a point in the gold move where you move $500 to $1,000 rapidly at some point in time here. And I suspect it's going to occur. We might have to fight our way back up to about 1900, but you get much into the 1900s again, and that's still below the high. It was 2070 in the summer. You get up in the mid-1900s, I think you could see gold go electric, where suddenly you get a price move out of gold that just opens your jaw. And it just takes a quantum leap beyond this ink of the last, we're below the 2011 high right now, by $100 or so, But so it's not exaggerated. Gold is just begun. And we expect its tenor and tone to change. And I suspect that's coming when we start to come out of this congestive pullback process we've seen for the last now going on 9 months, where gold's given up. Well, I think we're only about 14% off the high or something like that, 15 off the high. It's not a big deal, given it's taken 9 months to give back a small double-digit percent. So once this correction ends, expect gold to get far more volatile and probably spook the folks who dump their positions.